Tami Kesselman from AlignedInvesting. Please come up. How are you?
Good, how are you?
Good. And Adam Bendell, the CEO of Toniic. And I'll be moderating. So how many people in the room think of themselves as impact investors? Please raise your hands. And how many people do not think of themselves as impact investors? Okay.
And how many people will never raise their hand no matter the question?
So I have a little bit of a contrarian opinion about impact investing. And my opinion is that every investor, whether you say that you're investing for impact or for returns or for some blend of both, everyone is an impact investor. You either have positive impact, negative impact, or net impact. And so impact investing is really just about a spectrum of impact. So I'd like to kind of open up this conversation by starting with the two of you, and why don't you tell me what impact investing means to you? We'll start.
Yeah.
Sure.
Okay, so I'm going to probably agree and disagree, right? So agree in the sense that every investment has impacts, for sure, has social and environmental impacts, whether we're conscious of them or not. Disagree that every investment is impact investing in the way that that term is meant. That term already has plenty of trouble because it spans concessionary to extraordinary returns, for example. And so, I think of impact investing as investing, any investing that has a kind of rigorous social or environmental goal in addition to a rigorous financial goal. And that's not all investing, actually. Most investing doesn't have explicitly rigorous social or environmental goals. So I think, in a room like this, some of you probably hear impact investing and you think, ooh, bad idea. Take your eye off the ball of maximizing return. And some people probably think, inspiring, interesting, but I don't know if I could do that and deliver the market rate returns that I need to deliver. And some people may be thinking, I don't know enough about what impact investing is to have an answer to that question yet. So I hope that in this conversation we'll have a little something for everybody, wherever you are in that spectrum. Because I submit that actually everybody has something that they care deeply about beyond just making money. And in fact, that's what motivates the best entrepreneurs. And I'm guessing it motivates most of you as well. The best entrepreneurs want to change the world for the better. Impact entrepreneurs, at least as I would define that, Monique, is an additional lens that says there are certain ways to change the world that matter more than others. And so they are focused on the biggest challenges facing the planet or society. Challenges like hunger, poverty, the food system, access to healthcare, climate change. And there's lots of investments that aren't focused on that. But the intention in those kinds of investments is to make a tangible difference in one of those dimensions. That's what I would call an impact business, and an investment in one of those an impact investment. And the really big ideas of that kind aren't just incremental improvements to those problems. They're actually step change or system changers, right? So they work fundamental change on the food system, on the agriculture system, on the healthcare system, the education system, even the financial system itself. And so while impact investing includes philanthropic capital in foundations or in development finance institutions that are willing to have concessionary returns if they can have outsized social or environmental impact, it also includes things that look very much that are, as Tami was saying when we were talking earlier, that are just traditional venture capital with this additional lens on top. And I think that's maybe the more interesting part of the conversation for this group this afternoon. And it's basically, folks who will accept, who are seeking outsized return, accepting early stage risk that goes along with that, and they're motivated to solve a planetary scale problem, which is probably a $50 to $100 billion industry now, which is tiny by global financial standards, but is substantial, right? So over the last 10 years, there's been an ecosystem form around these businesses and the people who invest in them. And that ecosystem is what I would call impact investing. And I'll just kind of conclude by saying I think of impact investing as a kind of lens, right? So impact investors are using their impact lens as a differentiator. It allows them to see and to access opportunities that other people miss. Because the best impact entrepreneurs prefer impact investors. The best millennial employees are motivated to change the world, right? And they will walk through walls to achieve their collective vision. And consumers, by the way, love these companies, right? They will defend them when they stumble, and when they are doing well, when they soar, they become unpaid evangelists. So from my perspective, impact companies have an unnatural set of advantages that stem from their intention, their true intention to solve some of the world's biggest problems, which provides an extraordinary level of motivation for all of their stakeholders, for their employees, for their customers, for their suppliers, and for their investors. And those are actually advantages that money can't buy. And so I think of impact investing as taking the system of capitalism, the most amazing system for distributing and allocating resources ever devised, and harnessing it to solve the world's biggest problems. Like, who wouldn't want to be a part of that?
Yep, for sure. Tami, what about you? Why don't you tell me your perspective on it?
Well, and I agree with a lot of that. I think this is on. There we go. Hi. Absolutely, and I think that, Adam, you segued well to something I was going to talk about with impact investing. First of all, most impact investors would tell you that one of the differences is intentionality. So in order to be an impact investor, just because you invest in something and it happens to accidentally do more good than harm, doesn't make you an impact investor. Partly because if you're not measuring it, it's something that's very hard to have the upside effects that you would want. But also just riffing off of what Adam said, I think one of the important things for everyone here is looking at matriarchs and millennials as far as trends, and as far as impact investing not being just a bubble type of trend that's hip and trendy now, but something that's here to stay and going to keep growing in interest. Millennials, we're at right now, over the next 30 years, $30 trillion changing hands from this generation to the next generation. And millennials writ large grew up on an inconvenient truth in junior high, right? And so they grew up with a different DNA of not accepting that over here I can make money and break things, and over here I'll do some philanthropy and fix them. And they're much more the I want it all generation. And also, on top of that, you have money that's now transferring hands. Traditionally, for centuries, money transferred hands from the patriarch to the eldest son or sons. And I don't know what it is that happened over the last 10 years or so. And if someone else does, come tell me after. But something happened that now money usually transfers hands from the patriarch to the matriarch. And matriarchs, for a variety of reasons, outlive patriarchs. Patriarchs marry younger, women live 7 years longer anyway. So money's transferring hands. Patriarchs tend to, and this is stereotypical, but it holds, compartmentalize. Men are better at compartmentalizing. You can make money here, and then you can do philanthropy there. Women, by and large, are much more synergistic in their approach, and if they find out in their investment group that after the patriarch died of cancer that their funds are in tobacco and fossil fuels and anything else, they're not going to be okay with that. But don't make a mistake, they want to give just as much money to their grandkids. They want that legacy to grow. They're not doing it to get concessionary, but they want to figure out how to move that in a different way so that their whole portfolio works and their money doesn't work against each other. And in that way, it's very similar to whether it's male or female. Millennials are very much like that. So why does that matter even if you're not an impact investor? If you're investing as a VC in a consumer-facing product, those consumers are getting savvier and savvier and care more and more. And with the internet, there's a lot more transparency. And it's going to hit you in your market share. And it will hit you a little bit this year, a little bit more next year, and it's just going to keep growing because that trend is growing, that money is transferring, and more of that buying power. And also, as Adam talked about, more and more of the employees of the companies are going to care whether it's on your side or on the side of the portfolio companies you're investing in.
Thank you. So there are a bunch of different areas of impact investing. What do you think is sort of top of mind for you right now?
For me, it's not even, I like looking at trends across asset classes, and that's the other thing, that impact investing isn't just an asset class, right? It's across all asset classes, importantly. And one of the trends that I noticed and was really excited about over the last year or so is if you look at Exxon as just a bellwether for this entire conversation, there have been shareholder climate activists since about '97 that have tried to do different shareholder campaigns with Exxon and failed miserably. And then suddenly in 2016, if you think about all the divest movements, so Trillium and Rockefeller Brothers and Calvert, a bunch of universities were all out, right? They took themselves out of the conversation. They weren't at the table, they divested. So I really thought that the people at the table were the ones who didn't care. And in 2016, there was a 38% shareholder block in the Exxon shareholder meeting that tried to force out the chair and that tried to mandate to have Exxon put their climate footprint online and to discuss the risks of climate change in their annual report. And that represented a couple dozen of the biggest shareholders and trillions of dollars. And Chevron that same week had a 41% shareholder block. So I thought that that was impressive until this year. This past May, it flipped to 62% at Exxon's shareholder meeting and changed everything. So they now have their climate footprint. They now need to fully disclose their climate risk. And that the fact that it happened there where so many shareholders opted out and sold their shares should tell you about every other company and every other industry, and that this change is happening in real and happening not in a slow way. Stuff that absolutely, if you look at 2015, you're like, see, it's not relevant. If you start to look back last year and look next year, you'll find that all of this is becoming very relevant at a very rapid rate, no matter what industry you're in. And I think that that's exciting. Yeah. And it's exciting for people who see it first, because there's a lot of opportunities, that means, if you see what's coming.
Okay. And Adam, you're the CEO of Toniic, which is a community of impact investors. What are you seeing as trends, and are you seeing an uptick in the number of impact investors and an uptick in interest?
Yeah, so we're just because you guys know, but not everybody does, right? So Toniic is mainly is a community of mainly high net worth individuals, family offices, and foundations. So we tend to not be the institutional money. We tend to be more private money, but it's wealth holders. And our members span all 17 of the Sustainable Development Goals. I am pointing at a pin. I'm now a little sensitive in the current climate. What I am pointing at is a pin of the UN Sustainable Development Goals on Tami's dress. The 17 goals established by the United Nations in 2015 with specific 169 specific targets for solving these big planetary problems that I was talking about by the year 2030, making really significant progress on all of them. We got members working on all of those. Tami has talked about climate. I think climate and clean tech is clearly at the top. In some ways, environment and social are kind of the two sides of the coin. And there are lots of investors who are working on both, but there are some who are working on only one or the other. I think a trend is increasing specificity. So it's, people are kind of, what is impact investing? Well, is it just values aligned? Like I'm sort of divesting from Exxon if I don't like Exxon? And that is probably where it started, but it's sure not where it is now or ended. People get really, really specific. Like I was just talking with a member today whose impact themes are providing menstrual products to girls in schools in Africa and documentary films to change the policy debate. Like those are the two things she does. Okay, that's pretty specific.
And what is the deal flow like if you get that granular?
It's pretty small. And of course, if you overlay on top of that a geographic focus, which many of them do, a deal size focus, ticket size, the deal flow gets pretty narrow. Whereas at the fund level, which increasingly our members, there are now a more robust selection of impact funds. That's a more viable way for people at smaller wealth levels to get involved. I mean, still, of course, accredited. It's not retail yet, but then you will generally, as you get more aggregated vehicles for investing, then the focus tends to broaden because of the deal flow, sort of limitations. But in general, we see increasing specificity, and that applies both at the individual investor level and at the fund level.
But I think also on that, like I've been working with the UN, helping them launch a platform for a series of blended capital funds. So blended meaning you take grant money at the bottom of the capital stack, whether it's aid money or like Gates grants. And then you take, in the middle of the stack, you have like Rockefeller Foundation, subordinated equity and debt for first loss capital. And that way you're adjusting the beta. So you can bring in plain vanilla investors at the top of the stack at commercial rate return, but on these specific topics. And that's one thing that these sustainable development goals have been great for, is giving very different sectors that usually have very different languages, a same language, a same matrix, so they can find each other. And now we're finding creative ways to put together different types of capital. And so I think that's something that's been very new just in the last year or two, and that over the next 2 to 3 years, you're going to see a lot more of that. So a lot more specificity will be able to match around the world with the things they want to invest in, and with others who can come in at other parts of that capital stack to make the risks make sense.
So I want to go back to kind of some of the trends that we're seeing a little bit. Do you think the current political climate has changed what people want to invest in and their interest level in social impact and social good?
So I think the first thing you have to say, because we're global, right? The first thing you have to say is that that answer varies by where you are, right? So the current political climate, you know, when we're talking in the U.S., we generally think about Trump and you know, from a social justice perspective, for example, we think about racial equity, social justice, racial equity. In Europe, the conversation is much more about refugees, so those are related, right? Like we've seen kind of this broad sort of shift to the right, and there definitely is a counter response from that, from progressives. There's some alignment actually between there's a lot of alignment between sort of progressive and impact investing, but not 100% alignment. So that would be a mistake to think that. For example, the Vatican is very interested in impact investing. They had a conference a couple of years ago.
They have a big event today.
They have a big event
Their
today.
demo days today.
See, now that's not exactly what San Francisco progressives typically think of as the hotbed of progressivism, but yet impact investing. So,
and what are they interested in?
What are they interested in? You might know more than I do.
Well, they did their challenge this year, I think, was on refugees actually, and looking specifically at entrepreneurs and bringing together the top entrepreneurs solving refugee problems and bringing in advisors and investors, including a lot from Silicon Valley, which is why I happen to know about it.
So in the United States, we've seen an uptick in interest in investing in the middle of the country. Basically, good companies in the middle of the country. There is, I think, the left was awakened a year ago to the notion that there's about, at least half of the people in this country feel that they've been left out from the benefits of globalization and a culture that they no longer recognize, and that if that isn't addressed at some fundamental level, then the beatings will continue until morale improves. And so I think
you can certainly see that in the new Rise of the Rest fund that Steve Case just raised, the new $150 million vehicle.
Yeah, exactly. So I think that is also a place where deal flow is challenged. I perceive there to be more demand than supply, and just like everything else, if you sit in Silicon Valley, you tend to see companies that are birthed here more than you see companies from Cleveland or Detroit. So funds that are based there have an inherent advantage.
Mm-hmm. And is the number of companies who can deliver top decile returns and impact, is that number increasing, remaining the same?
I think it's increasing. First of all, there's a learning curve, and the more that people learn, the more they get better at it, just like any other sector that you invest in or any other company you've tried to launch. And so we see that learning curve, people are rapidly moving up it. And also there's just more and more opportunity, more and more awareness, more and more money that wants to find aligned opportunities. You even see that with just looking at the banks and the fact that they're all now starting to have impact fund products because they finally started losing clients. So JP Morgan excitedly, maybe 6 or 7 years ago, had written, co-authored, I think with the Gin, a report on impact investing as an emerging asset class, singular, which got a lot of people in the sector to poke a lot of fun at them for their entire title, proving that they missed the point. But then they moved to, a couple years ago, doing a $100 million fund, which they had in their corporate citizen office. So it actually wasn't, they didn't have any offerings in their wealth management area. And of that, they only allocated 50 million. And then you fast forward to this past year, and they just did a mapping exercise to map 100% of their product to the Sustainable Development Goals. And then from that, they can start to see where they are already in fintech, they are already in clean energy, they are already in a lot of things, and they can start to create product so that as demand increases, they now are creating product for their wealth advisors. And it's rapidly changing as there's demand, there's starting to be supply, and the more supply there is, the more that's helping to foster more demand.
And is that coming from bottom up? Is that top down? Where is that demand coming from?
I think I would love to hear what other people think, even in the audience, but I find that it's more bottom up, and again, in this trend of millennials, and as more millennials have more control over wallets, as there's more transparency just from smartphones and reporting and sharing of information over Twitter or anywhere else, as much as there's some crazy messaging out there politically and otherwise, there's also a lot of really good stuff. And if you care, it's easy to find your tribe, and it's easy to get that message out and get other consumers to think like you, who think like you, to find the same opportunities that you do and reward those.
Yeah, I mean, I agree. It's demand driven. The institutional money is being driven into this kicking and streaming by basically, the risk that they're getting out innovated by their competitors who are embracing the demand for these products. And so, and then I echo what Tami said about transparency. There are vehicles for doing this investing that did not exist previously. There are big name, more I'd say private equity than VC, but big name funds and banks who feel the need to offer this and are getting smarter about what they mean when they say, "Oh, we do impact too," and that is driven by, primarily driven by seeing market demand that is unmet.
And I think the other thing that's happening, the other money that's coming online, and you said a little bit about institutional, but even all the foundation money that's looking at, they were kind of called to task on that 5% goes toward mission, but then they had their 95% in their corpus that often was working against their mission. And so more and more of that money is starting to get smarter. And like you had Ford Foundation last year that committed $1 billion of its endowment to be aligned out of, I think it's at 10?
20. So
20.
it's
Yeah,
5%, which is
so they have a ways to go.
Small, but $1 billion is not small in
and
this
I think
world.
it's smart in that they're playing with it first. They're putting it out there, and then once they get that model to work, their goal is to continue to grow that, and you see that with Rockefeller and others. And with that money, I think that's also where, like Exxon, a part of it, that shift happened specifically because of BlackRock. And ironically, it happened because of Trillium. So Trillium, again, divested from Exxon. But what Trillium is a shareholder activist in, and they're small, they're a couple $1 billion, but they have CalPERS and Calvert and others that follow on with all their campaigns. So they have, I think it's more than an 80% of the time that management teams actually cave. So they don't ever get to vote. It just goes toward what the activism campaign was demanding on wages or on LGBT rights. And so specifically, it was LGBT rights in October, this past October, October 2016, that Trillium called out BlackRock very publicly with a shareholder action campaign saying, you have all these equal opportunity regulations, internally policies, but you vote 100% of the time with management, even though you claim to have a couple trillion of your fund that's impact aligned, and got them to shift. And so for the first time this year, I think it was the Occidental Petroleum Medium that predated the Exxon one, that they started voting their conscience instead of voting 100% aligned with management. So that was the beginning of it, of this trend of realizing, wait, what's authentic to me? And it's changing massive amounts of money all at the same time, like trillions of dollars in a moment, in one shareholder meeting, changing in everything they do.
Okay. We're going to take a couple of questions from the audience. What do you think of B Corp designations, and can this increase investment?
Okay, I'll go first and try to be quick. So B Corp, for those who don't know, is it's basically a questionnaire that a company. There's two different meanings of B Corp. Here we go again. So there's B Labs, which is a designation of a company that is basically trying to be sustainable across all of their operations. And if they get to a certain level in the scoring, then they become sort of B Lab certified or B Corp certified. There is separately a legal structure, an alternative to a traditional C corporation or a subchapter S corporation, called a benefit corporation, which many states, including Delaware and California, have. And that allows the constitutional documents of the company to include the consideration of social or environmental goals in addition to just share price in mergers and acquisitions and other situations like that. I think both of those are really important steps forward, but neither alone will do the job. I will be long retired before the S&P 500 is dominated by benefit corporations. So we need to, we're thinking about this across all, but they're both good tools.
And Tami, why don't you give us one or two examples of some of the most impactful companies that you've seen out in the world?
One thing that answering that as far as trends is looking at blockchain, which we've talked about earlier today, and the fact that blockchain a couple years back was like to make the dark web work, right, with Bitcoin. And you saw it evolve to mainstream, and now you're seeing it excitingly move toward social good. And so, for example, one of the companies that I'm advising and working with is leveraging blockchain in the Niger Delta for the cleanup of the 550 million gallons of oil that have spilled, mostly by Shell in the last decade. And Shell and USAID and others have spent a lot of money that's all gone to corruption and gotten lost. And so they're all actually really excited about blockchain and releasing funds for cleanup as they see verification of cleanup. So you're starting to see applications. And not just there, but all over. I think blockchain is really exciting in a lot of different ways that people are leveraging it, where there's a lot of money to be made doing a lot of good, a lot of money that was getting put in that was getting lost or not being spent effectively.
Okay. And what about exits? Have we seen any notable exits from social good companies? And if so, how are they exiting? Is it an IPO? Is it an acquisition by another company? What does the M&A activity look like around social good companies?
There's a mix. I think that it's not that different than anything else in the VC world. And I think that that's one of the biggest epiphanies for a lot of people is that this isn't rocket science. This is adding another level of diligence, which means if you do it right, you're actually have a higher upside, because if you have all of your current diligence and you add another level of what's the tenure look like and what's my impact, and you pass that filter too, that means you're making a stronger company. So your exits are equally as strong or stronger as well. I don't know if you have specific examples.
Well, I think there are some classic ones. And I echo, right? There's strategic exits, there are IPO exits. Before impact investing, the most of the attention in this space was on microcredit and microfinance, and there were some very notable, like Compartamos in Mexico, notable microfinance IPOs. But if you think about many of the health food oriented startups, acquisitions by P&G and that sort of thing. So very similar to what Revolution Foods, right? What you would see in any other. I think there's one difference, though, that particularly as you get to kind of deep impact in difficult developing world environments, they're not always hockey sticks. So these are not always sort of tech-enabled things. Some of them are expensive to deliver, and that might be fine with more patient capital. But the structure of a classic fund, 10 and 20, and 10 years and 2 and 20, management fee and carry and all that stuff may not work. And so there's a lot of innovation happening for this more deep impact part of the space in terms of structures that would be suitable. You could still make money, but it doesn't look like one unicorn and 9 failures.
But I just want to end on one other example that when people hear impact and think concessionary, the example I like to give is if you diligence and find a company that's doing doubling the density of lithium air and lithium ion batteries, think about that. Then that's not giving, that means that every electric car goes twice as far, every drone delivers aid twice as far remotely, and every solar panel works twice as long. That's a solid impact play, and that is not commercial rate return. That's more than 5x, it's probably more than 10x, right? That's an easy exit or an easy hold it and make a little sliver on every single battery that's bought using that IP. So it's about finding the stuff that matches your filter for what sector you're in and what you care about investing in, but adds this other layer where it's just gonna drive more money to it because there's more money looking for things that are social good and return.
Okay. And just in a very quick, tight soundbite, if an investor wanted to inject some impact into her portfolio today, how would you suggest she do that?
Okay, I'll go first. So I think it depends at what amount of money, it's obviously some amount of impact is really different if you're talking about a $1 billion portfolio or a $10 million portfolio. So it's a little bit hard to generalize, but particularly for at the smaller end of the pool, we really are excited about the funds that are much more pure play focused than they used to be. If you take somebody who has never done angel investing, and you say, now you're an impact angel, and you say the first thing you have to do is understand a term sheet and negotiate and blah, blah, blah. Now, recognize I'm dealing with a lot of individuals and family offices. That is the deep end of the pool, probably not where they belong. If you say, just do ESG screening, they're not feeling the love, right? It doesn't feel like it's connected to impact in the way that we think about it. So pure play impact funds are, I think, a sweet spot.
Okay, invest in impact funds. Tami?
Yeah, and I think find the thing that you're passionate about and find something that is a solution that helps to solve the problem. So in other words, something that has a market behind it. And if it's something that's new, don't put a lot of money in. But put some money in and play with it and see what you can do that's actually solving something in a way that makes money, because that means that there's a lot more money that can go into it, as opposed to things that are philanthropy where it's 100, you're losing, your alpha is negative, right? Like every dollar in is a dollar lost. You want to find ways to solve things. I think that's where the cool innovations are, things that are breaking the cycle, finding markets, creating markets to solve problems.
Thank you. Thank you both.
Good.